Michael Howell, who's the MD Crossborder Capital, joins in with his perspective. Michael, great to have you on the show. Thanks very much for speaking with us this morning. EM ETFs are finally becoming positive again. Will this trend sustain, you think?
I think it can be sustained. I think the issue to face is, or the two issues to face are, number one, what happens to the US dollar, and number two, what happens to China, and specifically Chinese monetary policy. The two big effects for emerging markets, the two major drivers, are the dollar and China. And therefore, the prospects for those two really will determine the direction and the speed and the size of capital flows to emerging markets.
What is your view on EM currencies? There has been some significant depreciation over there.
I think the first thing to say is to put this in context. Our mantra is that every emerging market crisis is first and foremost a currency crisis. And therefore, you can say on paper, this looks very similar to normal crises in the sense that currencies are weakened. But if you look behind the scenes, there are a number of very positive factors that actually mean that this particular sell-off in currencies is rather different from the past. And that makes us more optimistic looking forward. Now, the two things that I would say regarding that is that, first of all, if you look at the background for emerging market economies, and I'm going to be broad in that statement, and that conjecture includes Latin America, it includes India, the Indian subcontinent, and Asia, is that the generation of cash flow from emerging market corporations, from underlying companies, is far, far stronger than in past periods of emerging market crisis. So the underlying economic fundamentals look much, much better. The second thing is that if you look at the dollar, which is the other side of that currency depreciation, in our view, the dollar is somewhere near a peak. We're not in the school that says that the dollar goes up a lot from here. And the main reason is that we can see trends or deteriorating trends in the American economy, which may well expose a credit problem in America come 2019. And we believe that the Federal Reserve, as a result of that, will be challenged in their attempts to raise interest rates further. Consequently, the dollar may well come off. So in our view, number one, fundamentals are better, and number two, the dollar is not such a certain appreciation.
Okay, so 5 central banks are meeting this week. How will flows, you think, will get impacted, especially when it comes to emerging markets?
You raise an interesting point. Interest rates are going up. But I think one has to look at the context of the extent to which central banks globally have been tightening through other means. And one of those is quantitative tightening, particularly by the larger central banks worldwide. We evaluate these flows of liquidity, and our data tells us that currently 2/3 of central banks worldwide are running tight policies. Now, the more they tighten, the slower economic activity will be in emerging economies. And our perception about easing policy in America is really a 2019 issue. So what we believe is that economies will begin to slow down, led by America, and that will lead central banks to reverse course sometime within the next 6 to 12 months. So it may not be the correct time to invest heavily in emerging markets right now, but the point is that over the next few months, things will become clearer and the opportunities will be greater. And on your point about oil prices, we think we agree that high oil prices are clearly not good for India, nor for many emerging market economies that are importers. But as the world economy begins to slow down, some of the tension will come out of oil prices, and they should well settle back to more average levels of a little bit below here, maybe around about the $60 to $70 range.
So what is then your view on emerging markets from a medium to longer term?
Well, I think from let's look at three different scenarios. Let's look at short term, which may be the next 3 months. Let's look at the medium term on a 6 to 12-month view, and let's look at a longer term view, which is really beyond a year. I think that in the short term, we still remain very nervous of markets. Generally, this is not just an emerging market question, but it's really a question for all stock markets globally, simply because central banks are tightening. if 2/3 of central banks are putting the brakes on, stock markets will not be going very much higher. Because central bank tightening will cause economies to inflect, they will ultimately, this is a cycle that will ultimately attenuate. And as that cycle comes down, the cycle of interest rates, emerging markets and other stock markets will do well. And we think that the opportunity begins about 6 to 12 months out. The long-term opportunities for emerging markets are immense. They're huge. These markets are going to outperform developed markets very significantly. And investors in the West and investors in emerging markets themselves have got to have much greater exposure to these economies.
Right. Will the long developed market short EM trade unwind for the rest of the year?
I'm not sure about the rest of the year. I think that it will, in 2019, it will start to unwind. As I said, for the next few months, we still remain nervous of markets. And I think one can't, change facts here. That if you get a situation where developed markets are fragile, emerging markets will sell off perhaps more. So we do know that these markets are generally very skittish in terms of downtrends. Looking beyond that, these are the times when you ought to start to be thinking about buying in at lows. So once the markets bottom out, which we would suspect would be in the second half of this year, then we'd be much more interested about buying back to emerging markets. So 2019 should be a much better year than this year, but on a medium-term view beyond that, 2020, 2021, etc., emerging markets have really been the main thrust or driver of the world economy.
Okay, so how do you think this trade tariff related worries are going to impact flows?
Does the trade issue worry me? Yes, a little bit, but it's not really of great concern. And I think the issue comes back to fundamentally what this debate is about. And this debate is about technology transfer. And America has already given away a lot of its technology to emerging markets, but principally to China. And what America wants to do is to level the playing field in terms of not allowing that technology transfer to take place. In the case of many emerging markets, however, what we've seen is that technology has already been transferred, and many emerging economies are now innovators themselves. So America is closing the door, perhaps too late. And that's what fundamentally we believe that the trade war is really all about. Now, the key question, I think, for emerging market investors to ask, which is a rather strange question at first sight, is why the Soviet Union never caught up with Western economies. And the reason was that they did not allow capital flows to the Soviet bloc, nor did they allow technology transfer. Emerging markets today, for the most part, have got free capital movement and they've got permissible technology transfer. America may be trying to stop that, but it's too late in the game. Effectively, emerging economies are now innovators and they've got their own capital bases. And that's why the opportunities in emerging markets are so fundamentally good in the medium term.
Okay, thank you so much, Michael, for taking the time out and speaking with us, and good to have you on the show, highlighting what you feel about flows across emerging markets.